Here we're going to turn to the U.S. and we want to first kick off with the Fed funds curve and what some of the expectations are. So as inflation came in hotter than expected, PPI has bounced from all indications. The PCE deflator is going to be higher. And all of the key things that essentially the Fed looks at on gauging some of that inflation has moved up. So since then, as you can see, between January 2nd and February 21st, there has been a shift higher in what those expectations are going to be for the Fed funds rate. You know, our view was that it was going to be between 5 and 5.25. You know, we have now said that 5.25 is our base case with definitely some upside. Now you can see here, there is still an expectation of a pivot that is going to start in October and again, or into November. And as we've been saying, it's just, there is no pivot. And there's a lot of reasons why. Now, bond volatility had started to come down. Now you can see it's ratcheting back up. But even when bond volatility, because this is just looking at the MOVE index, even when bond volatility came lower, it was still very elevated given historics. And typically what the Fed has done to bring bond volatility down was issue quantitative easing. And because they don't have the ability to do so, one of the things we've been saying is that there's going to be a lot of these gyrations at a much higher level. And one of the things now as we move back to, you know, and because this is calculated the previous day, so this is yesterday's number, you can see that it's back to the highs and, you know, it took out the back above where we were in 2013, which was the taper tantrum. Then you have 2010 where you had some additional risk of a potential, you know, double dip recession. And so all of these things were real. And you could see that each time the Fed either cut rates, issued some sort of QE to bring that and cool off those rates. You saw it in 2020 when you had that massive spike, but now we're just holding at these levels because the Fed doesn't have the same abilities at this point in time, which is why rates are going to be higher. Bonds are going to go out. Bond prices are going to come down. Rates are going to get pushed up. Spreads are going to widen, and you're going to have those additional pressures. And each bank is going to manage it differently. So small bank reserves are as low as they are going to go, drying up a source of funding for loans. So when you look at small bank reserves, you can see just where they are in relation to previous. And again, they've come down for sure. As you can see, they've obviously come down, but it's not like they're at these all-time lows. And there is a certain amount of support that remains within these entities, but the question is the reserve as a percentage of assets, but the assets are getting more precarious. And if you have essentially large banks, they have access to additional types of capital where a small bank doesn't. So as you get delinquencies increasing on credit cards, as you get, you know, bad debt expenses going up, that's going to stress smaller banks more and more. And when you look at the advanced economies, that loan demand, you can see in the US, Eurozone and UK obviously as well, but look at the US, corporate demand is down, other household credit is down, mortgages are down. And when you think about a small bank, you know, their whole goal is to issue debt, is to try to make good loans that are going to increase some of the value that they can help solidify their balance sheet. But one of the things that we've learned long ago, it's obviously leverage matters, because if you have too much leverage, then any kind of move down would be just multitudes, worse. But how does this going to be managed? And as you get some of these issues where small banks might say, look, you know, we don't have the spare cash to go out and lend, then you're going to start to see a seizing of just loan procurement, loan growth, and just that normal trend. It also creates a problem because, and again, not being sensationalized at all, because leverage is vastly different now, you know, to a degree now versus '08. But runs on banks can happen very quickly, especially if you have several, you know, forwards or some sort of structure that goes the wrong way, goes against you if you wrote any kind of swaps. And not to say small banks write swaps, but it can spiral quickly. And that's some of the big problems, especially given where some of those small banks made loans, because money was free, money was cheap. Everyone was getting whatever they could get, and they were giving it away. But now when they have to do a postmortem on their balance sheet, on the credit risk they took, is there going to be a bigger problem? Is there going to be a need for something additional in terms of support? And that's going to be something that is it's something to watch. And we're not saying that it means that the banking system in the U.S. is going to seize up and collapse. That is by no means what we're saying. It's just, this is a problem. And it's a problem that is starting to crop up as we get credit, because credit card delinquency rates are on the rise. And when you look at it, we're at a new record high going back to 1991. Consumer credit delinquency rates rose to 7.19% at small U.S. banks in the fourth quarter of 2022, a record in Federal Reserve data going back to 1991. The rise in delinquencies at smaller banks, those outside the 100 largest based on assets, has led to an increase in charge-off rates, or the proportion of overdue loans that will never get paid back. And although they remain below that historic high, as we said, that's a bad trend, especially given where inflation is, where costs are going, and how sticky it's going to remain. The pressures on the consumer is not going away. So how much of that charge-off rate is going to go up as we continue to see some of these pressure points, especially when you start looking at the level of who is at risk. So share of credit card borrowers transitioning to 90 days past due by age group. You can see it's obviously 20s, 30s, and 40s. But those are the people that are, especially in the 40s, that should be spending the most to have the discretionary income. And they're creeping up towards the levels that we saw in 2006. And you can see how quickly that pivot can happen. And obviously, it's no surprise that the subprime delinquency rate by credit score continues to go up. But again, that's where how many of these people live in rural areas or smaller regions, smaller villages, and places that would rely on the smaller banks. And you kind of see where some of this stress can become a much bigger issue. Then when you look at U.S. credit card balances year on year, credit card balances in the U.S. increased 15.2% over the last year, the biggest jump since the 2001 recession. And when you look at this in relation to 2007, because a lot of people are going to look at delinquency rates and compare them to 2007, we never had credit card balances to this level unless you go back to when we were in the early 2000s. And you could see how quickly delinquencies ramped up in 2008, and we were at 9.6% credit growth. Now we're at 15.2 with more upside coming, and you get an idea of just how quickly things can spiral and why this is going to be an important point, especially when you look at where rates are going. And this is, I think, another important one when you look at the Taylor rule. As for those that remembered, we were talking about the Taylor rule, and depending on how you calculate it, here with the Taylor rule based on the current metrics, the Fed funds rate should be at 10.2%. Are we getting to 10.2%? No. But it just shows that there is a lot of room in the market right now for the Fed to raise rates. It also shows that there is no impetus right now to pivot, because it's telling us that we should be at over 10%. We're saying that we should get to now 5.25%, 5.5%. But again, by not going all the way up, it's going to provide an opportunity because it won't freak out the market. We've already seen the stress rising. If the Fed funds rate went to 10%, our credit card debt would go to 30%. I mean, we're already at 19.7%. So how quickly do we go to 30%? And then those delinquency rates just get exponentially worse. Our cost of interest expense is only getting worse and gonna stress further. And that becomes an underlying problem. And this is the key piece, the risk of second wave inflation. And that's what they're trying to avoid. And we have created this tried to explain that that's why they're not going to ease. Because if you remember, in 1976, as we went from 74 into 75, inflation was going from 12% down to 5%. And the view was, okay, we're on the right trajectory. We can start cutting rates. And then you had this acceleration. They want to avoid the acceleration, which is why lower than the Taylor rule by a fairly sizable margin, but stay there longer and avoid, or at least attempt to avoid, the failings of the 70s. And that's why the retail investor is just piling into the US market. And it's like, you just take a step back and you're like, do they know something I don't know? Like, is there a data point that they're looking at, or a broader piece that they feel comfortable in it? And again, we are not saying that the world is going to implode. Like, we think there's opportunity in fertilizer companies. We think there's an opportunity in food supply chain guys. We think there's some opportunity in some specific refiners and some other areas. Like, it's not like we're sitting here saying, oh, the world's dead, short everything. It's just, we wouldn't be piling into the S&P 500 at this point, given the risks that are presenting themselves. And then the terminal implied rate is at 5.3%. So again, to say that we think 5.25 up to 5.5, the market is coming into our realm of thinking. And remember, we were the crazy ones when we thought what was going to happen back in 2020. And then when you look at just the dot plot in terms of the Fed funds rates, you can see just how none of this shows a pivot. And again, that's why we continue to see some of this meaningful pause at this point. Now, here's some other pieces that are going to keep the Fed moving in those levels. Well, U.S. manufacturing up to 47.8 versus the estimate of 47.2. Services was much stronger. It came in at 50.5 versus the estimate of 47.3. Composite PMI then, because of services being so strong, came in at 50.2 versus the estimate of 47.5. And a lot of that was because of retail sales. Like, retail sales exploded in January. So we got a fairly sizable bump, especially in the services front. But on the manufacturing side, you're still contracting. And again, breaking it round numbers, 70% of the US GDP is services, 30% is manufacturing. So clearly this is a positive move, but then why is the Fed going to pivot? So in one breath, someone's going to say, oh, the Fed's going to pivot. And then you look at this data, it's like, but why? Like, where are they going? Like, where? Like, if we went from, the previous month of 46.8 to 39, okay, maybe we're seeing some pain, but we accelerated up. And again, do we think we come back into below 50? Yes. But again, we're not going from 50.5 to 45. We're going from 50.5 to 48.5, 49. So again, you're not getting this blowout low, this washout. Instead, you're just kind of bumping along, which is going to keep things in this level. And now new orders for the manufacturing went up. They were still in contraction, but rose. That's a positive. When you look at services, new orders rise versus the prior month, highest since October 2022. Output rose versus the prior month for manufacturing, highest reading since 2022. All of those are good things. Employment, all pointing higher. For services, went from 50.7 in Jan to 51.7. In manufacturing, went from 50.3 to 52.6. Again, all of that, when you think about the Fed and their dual mandate of employment and inflation, well, employment just went up. Inflation, as we saw with CPI, PPI, PCE, core, it's going up again. And again, you look at, these are reasons why. How can you say that, okay, well, the Fed's going to pivot? It's like, there is yet to be a pivot to the point where you're going to see these type of pressure points. Manufacturing new orders, again, February came in at 44.7. It was better than January, still contracting, which is why there's that mix. And then when you look at the global U.S. manufacturing PMI, input prices have come down, but output prices are going up. And that's that back and forth between where this inflation and again, leading that way into that stagflationary view, that stagflationary backdrop. But new orders, and as we've been saying, it's not this perpetual down move where we're going to spiral into oblivion. You're going to get to a point and then flatline and then kind of bounce around. And that's where we are. And that's where we think we're going to remain. Then you look at the percentage of industries reporting activity decline. In the last 6 months, it's going back up. And so when you look at every time we've been at these levels, are we going to continue going up? If we continue going up, it's a clear indication of recession. But this is a pivot point that's important. And when you look at the areas that are seeing declines, and based on some of the leading indicators, we still see some of those declines coming more on the retail side, sales, consumer side, back to the beginning of this segment. Now, when you look at the Conference Board leading economic index from the Conference Board fell in January by negative 0.3 versus the estimate of negative 0.3. Previously, it was negative 0.8. So again, it's not as bad as it was. Still contracting, but again, it's relatively mild when you consider those different pieces. Non-manufacturing index from Philly Fed rose to 3.2 in February. First time since July of 2022, index has been in expansion. And again, manufacturing got exponentially worse. But again, non-manufacturing, not as bad. And that's that back and forth because the service side, while it's also 70% of the economy, it's also a big driver of inflation, given obviously that's what the people are spending the most on. And that's where we see more of that driving pause and that driving aspect of, again, the inflationary move. 10 consecutive months of monthly contraction for the Conference Board leading economic index. Going back in history of the index and streak of this length has only occurred in recessions. Again, just more of this just backstop and backdrop of just more pressure on the inflationary side, on the recessionary side. 6-month annualized percent change in leading economic index from the Conference Board remains in negative territory, consistent with prior recessions. But again, it kind of it slowed. January was at negative 7%. Recent low was 7.7%. So again, that stabilizing piece is what we continue to talk about. Year-on-year percent decline in leading economic index from Conference Board remains negative, but hooked up slightly to 5.9%. But it's still at these lows, which is why we still see that pressure, and we still see, but then you have that other side where it's like, this is clearly recessionary. Then you have the other piece where you had retail sales that were strong, inflation that was strong, employment that has picked back up, new orders still contracting, but better than they were. And that's why we think that the Fed is essentially built in additional rate hikes. A welcome improvement of the breadth for the Conference Board leading economic index. On a 6-month basis, diffusion index continued to improve in January, but still, again, it's not, and that's where it doesn't continuously go down. You can see it kind of bounces up and down, and that's where we do expect it to come down again. Like it's nothing is going to ever be in a straight line. The economy is living and breathing. People's views are going to change and adjust as gasoline prices go up, gasoline prices come down, and people are going to be mobile and they're going to spend along that mobility side. So US PPI survey was at 0.4, came in at 0.7. Core PPI expectations were 0.3, came in at 0.5. Leading indicators for inflation. This is something that's showing that February and March are going to have that follow through, which is why we're going to continue to see these problems, especially when you start getting into March and April. As we get into spring and people get more active, there's going to be more of that pressure to the upside on inflation. Service inflation sticky, but obviously off the peak. 3-month annualized growth jumped back up in January to 4.8%. And then the PPI was expected, the core PPI expected at 0.2, came in at 0.6. 3-month annualized change in PPI finished goods ticked back up in Jan. Still relatively mild, but again, it's still a problem and still moving in the wrong direction when you look at some of these different flows, which is why the employment and profit side, historically, when U.S. businesses report that their profit margins are falling, typically employment follows with it. But as we've said before, you have accelerated retirements, you have a slowdown and really the participation rate is still abysmal, and that creates a lot of these long-term problems that are not going away anytime soon. So that's what we have for you on this side of the equation. The next segment, we're going to go deeper into the real estate piece and why some of that data got a bit worse after some of that reprieve that we had to start off the year.